Hey everyone, and today we'll be talking about two companies that seem to have a good potential ahead based on their recent filings. So, the first one is a defense electronics company that has been cleared as a production agency for multi influence ground mine and signed a TOT for advanced missile warheads. And the second one is a leading textile manufacturer that has picked up a 6.97% stake in a wind solar hybrid project to secure clean, captive power for its plants in Rajasthan. And together, the updates highlight defense readiness on one side and sustainability driven growth on the other. The two industries advancing towards stronger, future ready models. So, welcome to today's episode of Noisemaker, where we keep things simple and talk about companies that may not always come in the spotlight but have a really strong potential for future. I am Saijal, Equity Research Analyst at Desvelado Advisory, and today we'll be talking about two companies that are making solid progress in their business. And if current trends continue, they might keep growing even further. But before that, here is a quick look at the disclaimer. So, any discussion, facts, or writings provided here are for informational purposes only and do not constitute any buy or sell recommendation. So, please conduct your own due diligence before making any investment decision. Now, let's move to the first company, which is Apollo Microsystems Limited, a pioneer in design, development, assembly, and testing of electronic and electromechanical defense solutions. Now, the company recently received approval as the production agency for multi-influence ground mine MIGM Vighana under the DcPP by DRDO and also signed a TOT agreement for the Omni-Directional Multi-EFP Warhead for the NASM-SR Missile, which is a critical component of India's Navy short-range anti-ship system. The MIGM program alone is estimated at approx 2,000 crores, while the NASM-SR TOT enables indigenous production of advanced warhead technologies for future missile and naval platforms. Now, with FY26 projected to be a game-changer year and the Ministry of Defence expected to release rupees 2 lakh crores worth of orders, Apollo is well placed to capture a meaningful share under the DcPP framework. Now, this acquisition of ideal explosives further strengthens its position across the munitions value chain, moving it steadily towards becoming a Tier 1 global OEM. And now Deepali will be joining in for more information. So, Deepali, how are these opportunities showing up in Apollo's financial performance so far?
Thanks, Saijal. If we look at the financials, Apollo posted a stellar FY25 with revenue surging 51.2% year-on-year to 562 crore. Profitability also improved sharply. EBITDA jumped to 129.2 crore from 83.8 crore, with margins holding firm at 23%, despite project-based lumpiness. Quarterly trends were volatile. Q2 FY25 saw 76.2% quarter-on-quarter expansion, followed by moderation in Q3 and Q1 FY26. But what's impressive is the margin profile. Q1 FY26 EBITDA margin touched 31%, reflecting operating leverage from higher value contracts. Net profits more than doubled to 56.3 crore in FY25 and PAT margins improving to 9.9% and further jumping to 13.8% in Q1 FY26, their best levels yet. But Sejal, beyond this, their reported numbers, how is Apollo preparing itself for the next big growth phase?
See, that's a key point, Dipali, because Apollo is also aiming for a 45 to 50 CAGR growth over FY26 to 27, supported by a tripling of its order book by March 2026. Now, the revenues are expected to double in FY26, which would significantly scale up both the top line and profitability as well. And on the capability side, the company is allocating 100 crores towards R&D in FY26 and also targeting ownership of IP in critical systems like guidance, telemetry, embedded computing, and this should enhance margins, reduce import reliance, and open up royalty and export opportunities as well. Additionally, Apollo is scaling up manufacturing and targeting the defense exports of 100 crores in FY26, a key step in diversifying growth avenues. So, Dipali, with this mix of execution, IP creation, and exports, where do you see Apollo positioned within the broader defense ecosystem?
In my view, Sejal, Apollo is positioning itself as one of the most scalable and margin accretive defense players in India. Very few mid-sized companies can sustain 20% plus EBITDA margin and expand PAT levels at this pace. The large defense pipeline, IP-led initiative, and vertical integration with ideal explosive all give Apollo a clear edge. If execution stays on track, Apollo Microsystems could well transition from being a project-driven company to a Tier 1 global OEM, delivering integrated defense solution and are strongly aligned with India's Make in India vision.
Okay, thank you so much, Deepali. Now let's move to the second company, Nitin Spinners Ltd, which is a leading textile manufacturer offering cotton and blended yarns, knitted fabrics, and finished woven fabrics for domestic and export markets. Now, the company recently acquired a 6.97% stake in CGE2 Hybrid Energy Private Limited for 17 crores, securing renewable energy for its Bhilwara and Chittorgarh plants. Now, this wind solar hybrid project ensures reliable captive power, reduces dependence on the conventional sources, and strengthens ESG credentials, improving the efficiency and long-term competitiveness. Now, looking ahead, Nitin Spinners is also targeting around 3,200 crores of revenue with capacity utilization above 95%, stable EBITDA margins of 14 to 15%, and a 50 crores modernization plan while deferring major capex until demand recovery picks up. So, Deepali, how has this translated into company's financial performance so far?
Thanks, Angel. Financially, Nitin Spinners delivered a steady FY25 with revenue rising 13.8% year on year to 3,305.7 crores, supported by volume growth and realization despite muted textile exports. Quarterly revenue stayed around 800 to 840 crore, though Q1 FY26 saw a 5.7% quarter-on-quarter dip to 793.3 crore, signaling short-term demand softness. On profitability side, EBITDA improved to 471.4 crore with margins at 14.3% versus 13%, reflecting stable raw material prices and efficiencies. Net profit jumped 33% year on year to 775.4 crore with PAT margins climbing to 5.3% from 4.5%. Clearly, the company is managing volatility well, generating cash and sustaining healthy margins. But Sejal, beyond the current numbers, how is Nitin Spinners preparing itself for the next phase of growth?
See, sorry, that's a great question, Dipali. I think the company is set to launch a 1120 crores capacity expansion mainly in fabrics and to lift the share of value-added products from 35% to 40%, taking it to 50 to 60%. This expansion expected to be operational by FY27 and could nearly add up 1,000 crores of revenue while boosting the margins as well. And on the export side, Nitin Spinners is leveraging new trade agreements like with the UK to diversify its base across the EU, Bangladesh, and Vietnam, thereby reducing the indirect exposure to US tariffs. And with strong domestic demand and export diversification, the company is well placed to scale without being overly dependent on one geography. So, Dipali, given this strategic direction, where do you see Nitin Spinners positioning itself in the textile industry over the next few years?
In my view, Sejal, Nitin Spinners is shaping up as a resilient margin, stable textile player in a high cyclical industry. Its backward integration scale and export orientation give it a cost and competitiveness edge, while the renewable energy tie-up strengthens its ESG and operational resilience. The upcoming expansion into a value-added fabric should structurally improve margins and revenue visibility, making the company less vulnerable to raw material or demand swings. If execution stays on track, Nitin Spinners can emerge as one of the stronger long-term compounders in India's textile space.
Okay, thank you so much, Dipali. That really helped us to understand the direction both these companies are moving in. And now let's take a quick look at how some of our previous picks have performed. First is VST Tillers Tractors Limited from 4,575.2 to 5,327, and that's a gain of around 16.4%. Deep Industries Limited from just rupees 500 to 535.9, and that's a gain of around 7.2%. Then we have Ceinsys Tech Limited from 1,843 to 1,765, and that's a decline of 4.2%. Equitas Chemicals Limited from 1,177.3 to 1,418, and that's a gain of 20.4%. And lastly, we have Tilaknagar Industries Limited from 480.8 to 479.9, a minor decline of 0.2%. So overall, a pretty good mix of gains, and we'll continue to monitor all these companies closely to see how they shape up in the coming quarters. And here is the QR through which you can access all these previous picks coverage which we covered recently. And now let's move to the summary of today's company included in today's Noisemaker. So first we have Apollo Microsystems Limited. The company has received approval as the production agency for multi-influence ground mine Vighana under DcPP by DRDO and also signed a TOT agreement. And then we have Nitin Spinners Ltd. The company has recently acquired a 6.97% stake in CGE2 Hybrid Energy Private Limited. And that's it for today's edition of Noisemaker. If you found this breakout informative, you can scan the QR code to read the full report, and we'll be back soon with more simple and clear market updates. Until then, stay curious, stay ahead, and stay informed.